Welcome, everybody. Hello to all. Apologies for the slight delay. I had to set up everything up and running correctly because we had some slight technical issues. Hopefully, you guys are ready to begin. Okay, I see people joining in. Okay, let's give a few more minutes for the people to join. Hope you are all having a lovely Friday. Let's just leave it at Friday. Depends where you are, whether it's morning, afternoon, midday, whatever that is. Hope you're all having a lovely day. Please bear with me for a second. Can you please, guys, excuse me. Can you please, guys, let me know in the chat whether you can communicate with me? Just send a thumbs up or type something random, just to make sure that the communication between us is okay. Can you also please let me know whether you can see the first slide of the presentation? It reads Webinar Introduction to Technical Analysis, whether you can see that. That's of utmost importance. Whether you can hear me loud and clear, that's going to be something else we need to check before we start. And whether you can see me or not, that's irrelevant. Okay. Thank you, Maxime, for the confirmation. Okay, so I see people still joining. Welcome, guys. So, yeah, this is going to be the second episode of our series. Last webinar, we went over the most basic of the basic stuff. We went over some key terminologies that you need to familiarize yourself with when you start trading. We have also introduced the possibilities of what type, if that is one way of categorizing, what kind of trader you can become depending on the amount of time you have available to devote to trading. It's not for everyone, depending on the time you have available to you to do your research, do your analysis, and then your execution. You're most likely going to fall into one of those categories. You can find that on the prior webinar. This webinar, we're going to focus on technicals, okay? One of the most important aspects of trading anyways. So we're going to go over the basic key elements, the basic components. I'm going to introduce a few technical indicators that are going to be beneficial for you. But overall, this is going to be a super basic introductory kind of course, if you would like, or webinar into technical analysis. Okay, I think we are ready to begin. I don't see any more people joining. If they are joining, we're going to do a small recap. For the time being, let's get started. Welcome, everybody. And here we go. So this is a risk warning and a disclaimer. I'm not going to go ahead and read it out. You can read this on your own time. In essence, what we're talking about here is that this webinar does not contain any information in regards to investment advice or investment recommendation. It's purely for educational purposes only, and the redistribution of the material is prohibited. So for the time being, that's all you need to know in regards to this risk warning and disclaimer. Let's get started. What is the agenda of today's webinar? So what we will go over, okay? So a brief definition and introduction into what technical analysis is. If you're not familiar, we're going to provide you with a definition in order to make sure and you understand what kind of things or kind of processes can you do or are made while using technical analysis. What kind of different types of technical analysis are there? Which one might work best for you? And at the end of the day, with the ones that we will discuss, you can also see a few possible combinations of putting them together. I know this may sound very vague at the beginning, but please bear with me. You can understand what I mean as we progress through this webinar. Okay. So what is technical analysis? Okay. So, the gist of it is that the study of technical analysis is the study of market action through the use of charts in order to forecast some future price trends. In a sense, you're looking at past price action, and with that past price action, you draw conclusions and you extrapolate from there onwards what might happen to the price action. Therefore, from here onwards, as if you, let's just say you're looking at the current point in time in regards to any given instrument, from there onwards, what you need to do when it comes to trading is attempt, in other ways, to quote unquote predict the market, to see where the market is going to go. And by doing that, in a sense, take a position. Either you're going to go long or you're going to go short. Those are the two options that you have. Or the third option actually is to pretty much do nothing. Okay, so what's the point of discussing that? when we're talking about trading, you need to take action. So before you need to take action, you need to study the past price trends, what has happened in the past, and given this kind of rationale, because you study what has happened in the past, you can extrapolate from there onwards what might happen. Okay, that is not all, but that is the underlying philosophy behind technical analysis. So when we talk about studying market action via the use of technical analysis and the available technical analysis tools that you have at your disposal, when we talk about market action, we include three elements or three dimensions, if you like. One is price, and this is in order. So price is the first one, volume is the second one, and open interest is the third one. We're going to discuss all of those. Price is pretty much self-explanatory. Volume also as well. Open interest, a little bit more complicated, but you all get the gist. So some analysts also like to place much more emphasis on volume rather than price. And the reason behind this is because price has already been implemented. This is what you see, the past price action, the past decisions, in a sense, of traders that push the price action either to the upside or the downside. So price is already considered by some, a small group or a large group, I don't know, I don't have the data, is considered by traders to be outdated. Okay, so this is not providing you with any real-time information, in contrast with volume, which is more let's just say suited to that specific point in time, or is it more dynamic in nature, if you would like. So by learning how to spot increases or decreases or changes in patterns in volume, you can also get valuable information that could foretell what's going to happen into the nearby future, meaning depending on what kind of time horizon you're looking at. So price, volume, and open interest are the three key elements. Now, whether volume is more important than price or price more important than volume, it's up to discussion. As just a small disclaimer. Okay, so back to technical analysis. Technical analysis at the end of the day can be used in all time frames, either short term, medium term, long term, whatever that is. These tools or these available practices of technical analysis can be applied to any given time frame, whether you are a scalper, a day trader, a swing trader, or a long-term position holder, or a high-frequency trader, whatever that is. Pretty much all traders that spend time in the markets use some kind of form of technical analysis or some kind of tool that is available via technical analysis. We're gonna provide you with which those are and which are beneficial, or which ones you can put together to enhance your let's just say analysis before taking action. Okay, so technical analysts, in a sense, develop trading rules, which are super important, but also trading systems by using various theories, and there are plenty of them out there. You can do Wyckoff, you can do Dow Jones, you can Elliott waves, all of that are there. These are different philosophies which are looking, or different interpretations, if you like, that are looking at how price action is behaving, and you're in a sense trying to make sense of that kind of data by using various tools and rules and systems in order to arbitrage, to capitalize upon market moves and become profitable. Okay, so various and indicators, pretty much all of the available things that you have at your disposal to go ahead and trade. Okay, so there are three key principles in technical analysis. These are not written in stones. These are observations from successful and unsuccessful, or pretty much everyone that has participated in the markets in recent memory or in the past. By spending a lot time in the markets, you start to get the gist of things. And these are, in a sense, three, how would you call them? Three principles or three I don't know how to describe them, but in a sense, they are attempting, in a sense, to make sense of these chaos that we call financial markets, or markets in general. So the first one is market discounts everything. That means that at any given point in time, any information that enters the market is instantly, or not instantly, but in a very, very short period of time, the market is going to uptake that kind of information and price in that new development. So the market remains dynamic by incorporating new data that comes in it. That is not always true, but most of the time it is. Okay, so when a new financial news release is coming out and it's get broadcasted to the world and you see big reactions, those are the ones that we are trying to, in a sense, contain with this kind of small sentence explain. Okay, so market discounts everything. New information comes in, market reacts, corrects the price if it's too high, if it's too low, whatever that is. Okay, market discounts everything with new information coming in. Okay, price, the second one is price moves in trends. And if you pull up a chart and you look at from a monthly point of view, you start seeing some sort of patterns. So or trends, in other words, that's what you call them. So these are predictable market fluctuations, if you like, but we are looking at things in hindsight. Is much more harder to do that in real time. But the point is, at the end of the day, is to look back, see what has happened, find similarities, and extrapolate from there onwards that something similar may happen in the future if the parameters remain the same, if we don't get any new information, if because we're dealing with a lot of uncertainty, is really hard to guess excuse me, where the market is headed at. At the end of the day, we take the most basic of the basic approaches. So and at the end of the day, we are attempting to at least identify what kind of trend or what kind of phase the market or that instrument is in currently, and at the end of the day, go with it. Okay, is the most safe way to play things. Okay, so again, the third principle also ties in with the remaining two, the prior two, excuse me, which history tends to repeat itself. So technical analysts or investors or pretty much everyone that spends a lot of time in the market starts to get this kind of pattern recognition ability. And by looking at charts or different charts throughout time, you get and draw similarities and see that market is some sort of behaving on a predictable manner. And if you manage to do that via a lot of practice and struggle and grind in the markets, you again begin to start to see that there are structural kind of market moves or phases that the market goes through that in essence are predictable. And if they are predictable, you can capitalize upon that. Okay, so these are the three basic principles. Again, these are not written in stone. These are no rules. They are mere observations. Okay, they satisfy the generalistic kind of observation, but there are obviously at the end of the day exceptions all around the place every single day in the markets due to its chaotic, dynamic kind of nature. Okay, so what kind of types of different technical analysis are there? This is my interpretation. This is my point of view. You can find this kind of dichotomy of this split from many different people that are broadcasting this information out there in the markets. This is my interpretation. This is my way of providing this information to you guys. I like to split into two categories for ease of digestion, if you would like. So one category in my eyes is charting analysis. So anything you do on top of a price action, whether that is finding liquidity zones or demand zones or drawing support and resistance levels or drawing trend lines to have a visual illustration where the market is headed at, whether using channels or try to find chart patterns, anything that has to do with price action and the chart, naked chart. I like to put it in the category of charting analysis. So whenever you go into the price action and you just draw things you see, okay, finding these kind of levels that you may see the price action rebounding from or finding resistance breaking above from, those are falling under the category of charting analysis. Again, another category is what we call mechanical analysis. So these are computerized algorithms, if you will like. These are pre-programmed kind of pre-programmed algorithms that take in data such as price, volume, and non-pen interest, the key three elements we just mentioned in the prior slide. And in a sense, with various rules, they spit out, in a sense, an indication. Okay, these are what we call technical indicators. Okay, such as technical indicators are moving averages, which they are in a sense taking an X amount of periods in the past, add all those values together and divide them by the amount of days they are or periods they are, and you get an average to see how price action behaves around that kind of value. Okay, or that line. You're going to see that on your chart if you pull up, if you add on a moving average to your chart. Other ones are oscillators. There are a bunch of them out there. Bands and envelopes is another subcategory of mechanical analysis or a technical indicator that gives you this kind of information as well. And there are, at the end of the day, I don't know about thousands, but there are hundreds of technical indicators out there. Pretty much you can make your own as well if you have coding capabilities and you understand the markets with the parameters you know in a sense. But yes, these are free, available, pre-programmed kind of tools that convey specific information about any given instrument at any given point in time. Some are pretty much all are lagging by nature because they are calculating what has happened already in the past. A few of them are really calibrated to show you real time or as close to real time kind of changes in regards to market. For example, something like momentum or open interest and all that kind of stuff. Okay. So again, if whatever I've spewed out so far is vague for you guys, please bear with me. They're going to get much clearer as we progress, not only in this webinar, but in future webinars as well. Okay. So let's go back to the basics. And since we have mentioned that there is different types of technical analysis, we're going to go firstly with, where is my mouse pointer? Give me 1 second, guys. What is this? Oh, let me see. Laser pointing. Okay, so firstly, let's go with charting analysis. As we progress through this webinar series, we're going to do mechanical analysis and we're going to go each and every one of those, at least from my point of view, helpful indicators that you can put on your chart and give you this kind of inside information, which is not inside information, is freely available information that makes your judgment much more clearer. And if you use them and if you understand them correctly firstly and use them correctly, they can give you an edge that you can capitalize upon and, in a sense, raise the probabilities of becoming or remaining profitable in the financial markets. Okay, so from this webinar, however, we're going to stick to charting analysis. We're going to go through the super basics right now. Since we are dealing with charts, with charting analysis, let's see what kind of types of charts there are out there. Okay, mainly there are 3 types of charts. There's many more than that. You have period tables as well. So let's focus with firstly these 3, which are the most widely known ones. Line charts, bar charts, and what we call candlestick charts. Pretty much everybody I've seen in recent time are using this. Okay, candlestick charts because of their superior illustration of price action, but also other things. Okay, so let's begin with the line chart. In the past, this was the go-to kind of method of charting out past price action. Obviously, the oldest it is, it goes well here, the simpler it is. So line chart is the simplest of all charts. So the line chart consists of only a single line. You can clearly see here going up and down, up and down, up and down, blah, blah, blah. Okay, which at the end of the day connects 2 consecutive days or 2 consecutive periods using closing prices. Okay, so doesn't matter whether the market started at that, let's just say a stock price started today's session at $10. Okay, and at the end of the day, went to 17. Okay, next day, you're going to see the line going up to 17 and you're going to start from there onwards. Doesn't matter what has happened throughout the day. We don't know whether it started from 10, it fell to $8, it went to 15, it fell back to 10 and then finished to 17. We don't know that. We only know the close price, which is 17. And this is what the lines are connecting, in a sense, the past close prices. Okay. So from the get-go, you can see what kind of information is missing, which is the range, okay, of the day. How far the price of that stock fell in the day, how far it went up, and how much it closed. Okay, how much it closed, you can clearly see from a line chart, but what has happened throughout the day, you don't know that. Okay, and these are important. This is important to know the range of the trading day, because you can spot much more easily this kind of liquidity kind of areas where you can set up your place from there onwards if you are using this kind of technique. Okay, so the line chart does not provide any information about the trading range during the selected time interval. Yes, this is what I just said. So at the end of the day, for those of you that have not seen a chart before, hopefully there's no one of you that has not seen a chart before. If there is any one of you, I'm going to give you a brief explanation. So we have two axes here, so X and Y, okay? Pretty much as any given chart you can find in any kind of field. So the X axis, if you would like, is always time. So you have time on the bottom and on the horizontal line, if you like, and the vertical line is price. So at the end of the day, what is a price chart conveying to you? What is it telling you? How price behaved over time. Okay, so this up and down, this is what it says. Okay, so in this period of time, we have seen price action rally within this kind of range here. From here onwards, okay, I cannot see his way too zoomed out. From here onwards, you can see the price plummeting. Okay, so it tells you what has happened to the price over time. This is what charts at the end of the day conveying. Okay, so I think that's super simple to understand. Yep. Moving onwards, the second chart is what we call the bar chart. Okay, so this is a visual illustration of a bar chart. So if you are used to looking at candlestick charts, this may be a little bit of a gibberish to you, but fear not, it's not too complicated. You want to see what I mean? I'm going to explain it to you how to read them correctly. Okay, if you're looking to use them. So before we do that, let's just spot something else. Firstly, let's break it down, and then I'm going to do the observation. Okay, so whenever you see these kind of lines with the two protrusions, one on the left and one on the right, okay, clearly seen here. One is there and the other one is down here, okay, and these are the range. Okay, so bar charts are conveying range. They are telling you how far the price action has risen and fallen within that specific point in time, unlike the line chart we just saw. Okay, so how to spot the open price and how to spot the close price. Okay, on the left hand side of any given bar, okay, on the left hand side, okay, that is always the open price. Okay, on the right hand side, that protrusion, okay, on the right hand side of this kind of bar is the close price. So from here onwards, if you know that on the left hand side is the open price and the right hand side is the close price, you can clearly tell whether the price action ended the day in the negatives or in the positives. Okay, whether that bar is bullish or whether that bar is bearish, in other words. Okay, so if the open bar, okay, excuse me, if the open price of that bar, okay, is lower than the close price, that means the price action closed the session in the greens. That means that the price action rose within that session. We don't know how much, we do know how far, but we don't know whether price action opened here, went up there, came down here, and closed here. We don't know that. We just assume. Okay, so and there are very different interpretations of looking at candlesticks, and we will do a specialized webinar on how to decipher candlesticks, individual candlesticks, because they do convey a lot of information that you might overlook. Okay, once you start learning how to decipher them correctly, they are giving you information that you, if you know how to interpret, they are indeed giving you an edge. Okay, they're giving you extra information about your assessment, whether it's correct or not. You're gonna put that all together with the technical indicators and volume and all that kind of stuff. Okay, but sticking to the point, so a bullish bar, open price is always lower than the close price. When we have a bearish bar, the open price is always higher than the close price. Okay, and that is in essence how candlesticks are formed as well. So the reason why I painted green and red is because most likely you're familiar with candlesticks and you have imprinted in your own head that green means buying or means bullish, or the red bar means bearish, that means falling price. Okay, so again, recapping and then moving onwards, a bullish bar, the price action is always lower than the close price. A bearish bar is where the open price is higher than the close price. Okay, I'm gonna give you a question, guys. Do you know what a doji is? A doji is, in a sense, a bar where the open and close price are pretty much at the same level, maybe a little bit above it, maybe a little bit below it, but most of the times when we have an actual doji, it's the open price is similar to the close price, irrespective of the trading range. Okay, those are also conveying information. Okay, and we're gonna look at them in a future webinar and see what kind of implications they have and what kind of information they convey. Those are super nice omens. Those are super nice signals that you can learn how to spot, learn what can come after them. And if that is the case, if the price action moves as expected, you can actually capitalize upon that. Okay, so the last type of charts is the candlestick charts. Pretty much I'm assuming pretty much all of you guys are using candlestick charts. They are indeed superior to the prior two, the line chart and the bar chart, but some people like to, I've seen people successfully trading the market while using only line charts. It's weird from my point of view, but if you can utilize this, if this makes sense to you and you can capitalize upon this, and you can become profitable by trading the markets using line charts, please go ahead and do that. Okay, if that works for you, go ahead and do that. Okay, most people, however, are using candlestick charts because they convey extra information, much just like I said. So let's break them down. So the area between the open and the close is what we call the real body. Okay, the real body is, in a sense, guys, can you see my mouse pointer? If not, I'm going to start drawing on the chart. Please give me a thumbs up. Hopefully you can. So the real body, in a sense, is this. Okay. So the above and below protrusions are what we call wicks or shadows. Super important as well. Okay, so the real body, the area between the open and the close is what we call the real body, and price excursions above and below the real body are what we call wicks or shadows. The candlestick charts are visually superior to bar charts and line charts and are therefore preferred by traders. Okay, remember, these are the same thing, huh? Okay, so candlesticks and bar charts are the same thing. Candlesticks are a little bit more thicker, and they outline, in a sense, the open and the close, the area between the two. Okay, whereas bar charts do not. It's just a simple line, but they are conveying the same thing. You have the excursions. This is a wick. This is another wick. Okay, so the open and the close. Okay, so bullish candles and bearish candles, again, the same logic applies. Whenever you have an open price lower than the close price, or in other words, a close price higher than the open price, that is a bullish candle. And the bearish candle is when you have the open price being higher than the close price, or in other words, the close price lower than the open price. Okay, this is the information. Wicks and shadows, we're gonna do them in, we're gonna look at them in a much more deeper level when we do candlestick analysis. Okay, so charting analysis, once again, zooming out and going back to the two main categories of charting analysis. of technical analysis, excuse me, the ones I like to break it down towards two. We have charting and mechanical. So charting analysis, these are the available tools. Some of them are available tools and other are practices or pattern recognition kind of abilities. So support and resistance levels, these are areas, if you're not familiar with this, support and resistance levels are areas of friction. Okay, whenever you see the price action, let me draw something out to have much more. If you have something like this, okay, this is in a sense what we call a resistance level, okay, because price action fails to break above this area once, this area twice, this area three times, and this is what we call support, this is resistance, and this is support. In a sense, the price action is bounded between these two areas, these two lines, or these two, I don't know how else to call territories, okay? So support level is when you see the price action failing to break below from because the buying interest is sufficiently strong enough and the bulls, in a sense, are pushing back on the strength of the bears, of the bears, pushing the price action back higher. So one, twice, three times, that constitutes a lovely support level for me, at least in my eyes. Some people like only two touches. Okay, so price action rises from this level, heads up to this level, doesn't go anywhere, comes back once again and finds support, moves up once again, finds resistance, again falling back down, support, resistance, but in due time. Okay, let's just avoid this. Okay, let's just say it has found support once again. Okay, and found support for the fourth time, and this tells you that the bulls are eager to take the price action, to take hold of the price action and steer the direction of this kind of instrument, whatever, imagine whatever instrument you like, or FX pair, or commodity, or stock, or whatever that is. Okay, so bulls are eager to push the price action to higher ground. Up until here, we do expect the price action to reverse back. Once again, this is a channel, okay? But for some reason, the bears are not able to. The bears are the ones pushing the price action lower. The bulls are the ones that are pushing the price action higher. Okay. At this point in time, the bears did not manage to contain the strength of the bulls, and from there onwards, we call this a resistance break or a breakout from a prior resistance level. That means the bulls are strong enough and have overtaken the not dominancy, but they have taken the initiative from the bears and they pushed price action to higher ground. Okay, so this level right here is what we call the breakout point. Okay, and you can you can find these kind of areas from a long-term point of view. You can draw them onto your chart with this. These are what we call support and resistance levels in order to have a visual illustration of where the price action has stalled from and where it has rebounded from. Okay, this is what we call the rebound. This is a rebound. Okay, and this is what we call a pullback. Okay, or a retracement. Okay, price action fails to break above, retraces, falls back down here, rebounds, retracement and rebound, retracement and rebound, and in due time you get some sort of break either above or below. It's a breakdown or a breakout. Okay, hopefully these I'm not confusing you. Okay, so this is a visual illustration of a resistance and support level. So these are super simple lines that you can draw on your chart. It does not mean because you have drawn a line onto your chart, firstly, is valid, and second, that is going to hold. Okay, market does not care whether you draw a line at the, I don't know, 110 and the $90 range. It doesn't care. Okay, if the bulls or the bears are strong enough, if there is enough momentum, if there is enough volatility, if there is enough liquidity, you resistance and support levels do not hold. Okay, the market moves in what direction it wants to move depending on how traders are behaving to incoming information or any other factor available in the markets. Okay, so trend lines. Imagine, for example, that the price action is heading higher. Okay, so it's making higher highs, higher and lows. This is what we call a trend line. In a sense, I'm sorry, guys, I'm terrible at drawing with a mouse. So in a sense, this was supposed to be fitting nicely here. Okay, something like this. Okay, so whenever you see price action making higher highs, this is a high and a higher low. This is a low. This is a higher low, higher high, higher low, higher high, higher low. You can draw what we call a trend line. In this kind of case, it's an upwards moving trend line or an ascending trend line, highlighting in a sense what you already know. Price action is moving to high ground. Okay, trend lines are used merely for visual illustration purposes. Okay, some like to use them as support levels. Fair enough. I can accept that, but they're only for that. Okay, the visual illustration to have clear indication where the market is headed at, and not forget if you need that. If you need to draw that, fair enough. If not, okay, fair enough as well. Opposite example is what we call a descending moving trend line. Okay, so the market is making lower highs. This is a lower high and a lower low, a lower high, a lower low, a lower high, a lower low, etc. So whenever you see this kind of sequential moves, zigzags towards one direction, you most likely can draw a trend line, which indicates, once again, where the market is currently headed at. Okay, nothing else, nothing more. Okay, no support, you can use them as support and resistance levels. Fair enough. I personally like not to. Okay, but I can see why people use them like that. Fair enough. Channels. This is a channel. So in a sense, the price action is doing pretty much nothing. It has no clear direction. Is moving on a sideways kind of moving channel. Okay. There are different types of channels. We have upwards moving channel or downwards moving channel. This can be also another channel. This is a downward moving channel. So in a sense, two parallel lines where the price action fits neatly within it and rebounds and retraces from. Same thing can be told here. This is an upward moving channel. Price action has been bounded between these two lines for that amount of time. Okay, so these are lovely tools that you can use on your chart, again, for visual illustration purposes only. Okay, so you minimize uncertainty in this kind of way, at least visually. And once you start learning how and what kind of implications this kind of short-term patterns are being made in the market, are shown in the market, you can clearly take positions from there onwards if you see a break either above or below. For example, in this kind of case, this is a simple chart pattern. So this is what we call a bull flag. Okay, so imagine a big spike. Okay, and then the price action does this within a descending channel, doing this. Okay, this is what we call a chart pattern. Again, this is not written in stone. These are, again, visual, no, excuse me. These are observations from past activity, okay? Past traders, past experience, the ones that have extra experience, that have seen this kind of thing playing through. And the most likely scenario afterwards was a break above it, okay? And then another spike afterwards, okay? This is what we call a bullish flag. A bullish flag. Okay, so once you, for example, see a big spike, okay, it might not be straight away, it might be something like this. Okay, same thing. Okay, and then you see this. This is a lovely sign that possibly the market is gonna jump right back through, because it has eaten all the pending orders right there, all these sell limit orders, all these take profit orders from there onwards, the ones that wanted to escape the market, but they, because of enough bullish momentum and sentiment or predisposition, price action meets all the orders in here. And the only way is upwards, because the bulls are eager once again to push prices to high ground. In a sense, these kind of take profit orders are being taken out, and then cleanly the bulls are steering the direction of the market. In a sense, the bulls have obliterated, in a sense, the strength of the bears, the ones that want to push the price action to lower ground, and the only thing left is only bulls. So therefore, you're going to see probably high uptick of price action, high volatility, and sharp price movements. You can clearly spot this on crypto markets all over the place, mainly because, once again, traders are super bullish on crypto pretty much all the time, except a few periods of retracements, of sharp retracements. Anyway, these we're going to discuss a lot of these chart patterns into the future. This is just a small visual illustration. Let's move onwards because we don't have much time, unfortunately. So this is a few examples of charting analysis. Let's move on to the next category, which is mechanical analysis, and more specifically, we're going to split it into two. I have not, a slide is missing here, unfortunately. So this goes on to under the bracket of mechanical, oh my days, mechanical analysis. Okay, so let me go back and you'll see what I mean. Okay, this is the split of charting analysis and mechanical analysis. Now we're talking about mechanical analysis. We finished with charting, gave you a few examples. Let's move on to mechanical analysis. So we have another split of mechanical analysis on chart indicators, and the other one is off chart indicators. So another forking, if you would like. So fork two, one, and one leg, or under this umbrella, you have two categories. So on chart indicators, these are the ones that go on top of price action. Do I have a visual illustration? Fortunately not. Okay, so these are technical indicators, again, computerized algorithms that you put in a few information and they spit out a line or a chart, not a chart, but most likely a line or an oscillator below the chart, which is going to be on the off chart, which are conveying information. On chart indicators, a few examples are what we call moving averages, super simple and insightful indication that you can have on your chart, again, to confirm whether the market is moving to the specific direction. Pretty much that's it. Or whether the market has shifted from its current trend and it's entering a new phase. Okay, that's how you use moving averages. Okay, other on-chart indicator examples is Bollinger Bands. These are measuring, in a sense, extreme moves. We are going to do a special webinar on Bollinger Bands. Super informative, really nice, because they are using a few in their core, they're using statistical concepts such as the standard deviation. So how far the price action is going to go, most likely it's going to come back down and control the movement. So a reversion towards the mean kind of rationale is applied there. Bollinger Bands are super efficient and they are super dynamic. So they adapt depending on the volatility of the price action. If these words mean nothing to you, please tune in for the webinar. We're going to do Bollinger Bands because they are indeed a very nice technical indicator that you can do on your chart. I'm merely laying out a few examples of on-chart indicators here. This is what I'm doing in this kind of slide. We're not going to go into much more detail because of time, firstly, and because of the complexity as well. So we're going to build up as we progress through this series to be able to comprehend this kind of material once it arrives. Okay, so another on-chart indicator is what we call Ichimoku cloud. I must say I'm having a little bit of trouble understanding it fully, how this kind of indicator works. I'm still trying to make sense of it. I'm getting the gist of these kind of indicator Ichimoku clouds. They have a lot of parameters in it that is conveying a lot of information about the recent past or the current point of view, which are complicated. Hopefully, I'm going to do my best to create an easily digestible webinar that is going to be talking about Ichimoku Cloud, because I do see potential, and many other people are seeing potentially using the Ichimoku Cloud on their charts in order to get this kind of edge once again. Okay, so Ichimoku Cloud is something that hopefully is going to be on the agenda in this new series. Okay, so another example is what we call the parabolic SAR, or SAR, another technical indicator that goes on top of price action. This is the common thread between these four examples of technical indicators that I have just broadcasted to you. They are going on top of price action, in contrast with the other category, which is off-chart indicators, which are going on a separate window or on a separate plane. No, not plane, pane or panel, excuse me, panel, that's the right way, on a separate panel below the price action, so it has no overlap with price action. So you have a separate window below your chart that these indicators can be found if you add them onto your charts, onto your terminal, if you would like. Okay, so RSI, the relative strength index, something I really like to use on a day-to-day basis. Measures the strength of a move, also measures the bias of the bulls or the bears depending on the time of the day, and it is actually giving you a lot of lovely signals which you can capitalize upon. We're going to do a special webinar once again on RSI, also MACD and ADX, but also momentum. Okay, these are the ones I like to use specifically personally, but they are also the ones that have the most empirical kind of data or studies when you look at academic kind of papers. Okay, so they are the most rigorously kind of tested technical indicators that provide some sort of value if and only if you understand what information goes in them and what kind of information they convey. Okay, by pulling it on a chart without understanding how it works, what it's using, and what are its disadvantages, they're not going to provide you with any kind of clues. You need to understand how they work first, what information goes in them first, and what kind of information comes out after the computation. You need to understand the computation process in order to use it at the point where it's most useful. Okay, because it's not useful to use, for example, moving average convergence and divergence, the MACD, when you have an instrument or a market that is not trending. No need to do that. Okay, it's clearly used and adopted and calibrated for markets that are either moving to the upside or to the downside. So whenever the market has a trend, MACD is going to be beneficial. Okay, whenever a specific market is moving in a sideways motion, is not going anywhere, neither the bulls or the bears are in control, MACD is irrelevant. Okay, because it needs to compute, it needs to have a clear direction of the market in order to see how the market is going to fluctuate and by how much. Okay, how much momentum is there behind those kind of moves. Okay, so in contrast, when you have a market that is moving in a sideways manner or sideways fashion, you can use other technical indicators such as the CCI, Commodity Channel Index, which is clearly calibrated for those periods of sideways price action. Okay, so at the end of the day, what we are attempting to do here is introduce the available tools that you have at your disposal. Okay, but also use them where they are actually useful. Okay, and avoid the ones that are not, and also mix and match technical indicators that are conveying different information, but they somehow coalesce. They're not random, or add 5 or 6 technical indicators onto your chart which are conveying the same thing. There's no need to do that. You only need one. Okay, so the convergence or the confluence of these kind of indicators is what is going to be beneficial for you in your trading journey if you're using merely technical analysis. This is what we're going to be doing in this kind of series. Okay, so back to the examples. So RSI, super important, at least from my point of view. Moving average convergence and divergence, MACD is another one. ADX is another one, gives you how strong the strength of the buying power or the strength of the bulls and the strength of the selling power, but also the momentum, also a lovely indicator. We will do a special webinar. And the last one is the simple momentum. Simple as it is, it's super, super beneficial. Okay. Again, if you understand what information goes in them, how the information is computed, and what is spewed out for you to see. Okay. Other tools that fall under the mechanical analysis kind of category, which are going onto the chart, are what we call Fibonacci. Okay. Again, we're going to do extensive kind of deep dives on Fibonacci, more specifically retracements and expansions. Maybe we're going to do extensions as well. Super interesting, but highly controversial, not topic, but as a technical indicator, it has a lot of woo-woo and mysticism and fascination behind it. Some love it, some hate it. We're going to introduce it merely for you to get the point. Hopefully, if it makes sense for you, you can use them accordingly. If not, fair enough. Okay. But yeah, also Elliott wave theory, super important, which kind of measures or attempts to measure or describe this kind of systemic kind of phases of the market. If you learn Elliott wave early on, you're going to see how the markets behave. Okay. So again, a little bit much more difficult topic to discuss, but also learn. But at the end of the day, those are the ones that matter. Okay. So which might work best for you ultimately depends upon you. Okay. Do you like to have 10 indicators on your chart, or 5 or 2 or 3? Is the extra information paralyzing you? Then there is no need for you to use technical indicators. Okay. At least use 1 or 2 that are the ones you understand the best, and they are moving and they are conveying information that can be useful for you. The gist of the thing is that the less, the better. So from personal experience, maximum 4 is the one I can deal with. When it goes to technical indicators, some like to use much more than that. Fair enough. But from a point onwards, you may get lost in the signals, you may get lost in technical indications and lose moves. So at the end of the day, which works best for you is the ones first that you understand, okay? And the ones that you comprehend what kind of information they convey. And at the end of the day, add a few of those which are not the same, but they're conveying different information, and they can be put together, that they're going to create, in a sense, a system, a trading system that is going to be beneficial for you to capitalize upon and execute your trades and become profitable. Okay. So again, it's an open-ended question. Which one works for you? I like to use MACD. I like to use RSI. Simple moving average here and there. Bollinger Bands is something else I'm looking at on top of charting analysis. Again, the style ultimately depends upon you and whether you understand what information is conveyed. Okay, so guys, unfortunately, we have to close the session shortly. Do you have any sort of questions before we go? Everything is clear. Again, this webinar, fortunately or unfortunately, was supposed to be super basic. Again, it's an introduction into technical analysis. Hopefully these kind of topics, this kind of conversation, this kind of lecture, because you were not communicating with me, I was just talking. This information conveyed broaden your kind of horizons of what kind of possibilities there are out there in regards to the technical analysis sphere, and what kind of technical indications you can use on your chart. If this was informative for you, fair enough. If you have questions, unfortunately, you need to send me an email to address them if you like. If not, hopefully I'm going to see you on the next webinar, where we're going to be diving much more deeper into all of these topics we have discussed today because we've opened a lot of fronts. Okay. So as we progress throughout this series, we're going to take one topic and break it down, digest it, and then move onwards. Near the end of this series, we're going to put everything we've learned so far and do live trading together. Okay. By the point of timing, this was just an introduction. Hopefully you have enjoyed it. Okay. I don't see questions. I'm assuming everything is all good with you. You have understood everything. Then we have to leave it here. Thanks for watching, guys. Hopefully, we're going to catch you on next week or the week after that, unfortunately. Next Friday on the 29th. Okay. So take care. Bye-bye. Have a lovely, lovely weekend. If you have questions, send them through. More than happy to answer them. Okay. So take care. Bye-bye.